Hi, this is Nick here, and I'm about to go through the U.S. interest rates chart book. This is the first of that series, and I'll plan to put this out on a monthly basis going forward. So as I go through here, I'll start with sort of the shorter term interest rates and move out to longer end interest rates, starting here with what's priced in for Fed rate hikes for this year and next. So basically the market is expecting 3 or 4 rate hikes for 2018 and 1 or 2 rate hikes for 2019. Those are 25 basis point increments. The Fed came into the year with the Fed funds rate at 1.5%, and they've hiked twice to 2% currently. So 2 more hikes this year and 2 next year would bring the rate to 3%, which would be sort of the upper range of what's expected currently. Alternatively, if they only hiked 1 more time this year and once next year, that would bring the rate to 250. Now, just a comment, a technical note on talking about these Fed funds rates. It used to be before the global financial crisis that the Fed had a target rate, and that was 2% or 2.5% or whatever it was, and that was that. So there was no difference, or not much difference, between the effective rate and the target rate. Now, basically, this started around the time that the Fed had interest rates down at what they called the zero lower bound, but basically. Now they have a target range scheme where, so currently I say rates are at 2%. That's actually the upper bound of the Fed funds target range. The lower bound is 175, and then the effective rate is somewhere in between. So somewhere in the middle of 175 and 2% is really the current effective rate. And so on some of my charts, most of my charts, I'll just refer to the Fed funds rate as the upper bound because that's consistent with the old regime prior to this technical change, that occurred in late 08, early 09. But where it differs, I'll make a note of that. So moving on to the second chart here, market expectations of the Fed funds rate in 2 years. So here's where that becomes relevant because the Fed funds futures are actually priced based off of the average for that month in the effective rate, and the effective rate tends to be pretty close to the midpoint. So right now you can see that gray line here is showing the midpoint is 1.875%. That's the midpoint between 175 and 2. Then looking at a longer term chart here, so back in these earlier decades, the Fed just had the one target rate, and that was the Fed funds rate. So here, consistent with that methodology, I'm using the upper boundary of 2%. Here's the current rate. You can see that the Fed hiking cycles have peaked at lower interest rates successively, and I would expect my base case scenario would be for this hiking cycle to peak at a lower rate than the previous cycle. The previous peak was 5.25%. I've just drawn in these gray trend lines here showing the lower highs and the lower lows as well. Obviously here you run into the issue of what the Fed refers to as the zero lower bound. Then the dotted line here shows what's priced in on the futures market. So for the Fed funds futures, that's pricing the hikes go up to about 2.6% to kind of level off there. But that fluctuates with obviously with market expectations, and that's driven by Fed communication and by economic data and things like that. Then here we have the Fed funds rate in black and the U.S. financial conditions in gray. This is the Chicago Fed National Financial Conditions Index, which I use in some of my other chart books. I think it's a particularly well-constructed index. And that shows that financial conditions, these are basically trying to capture real-world financial conditions, are actually still very loose, despite all these Fed rate hikes. Now, a number of reasons behind that, but one thing to keep in mind is that Fed rate hikes are monetary policy changes by the Fed tend to work with a lag, and so not all these rate hikes have necessarily filtered through into real-world financial conditions. But given that the Fed has communicated that they view basically the neutral interest rate as being around 3%, which would be up here, my expectation is that the Fed will continue to gradually raise rates towards that level, especially provided that financial conditions remain very easy for the time being. Then here I want to get into a discussion about the The yield curve, the most commonly looked at is the 10-year and 2-year yield. So the 2-year yield is in gray, 10-year yield is in black, Fed funds rate in blue here. And when the 2-year yield goes above the 10-year yield, that's referred to as yield curve inversion, and that's often a recession risk, a warning sign. There has been some commentary recently from Fed officials that have indicated, some of them have indicated that they would not knowingly vote for a Fed rate hike that inverts the yield curve. They're getting cautious about the flattening yield curve. You can see here, back in the last cycle, obviously the Fed funds rate was hiked above the 10-year yield back in early 2006. So then zooming in a little bit more on the 2-year and the 10-year yield, that's represented on the upper panel. You can see that that gap has been narrowing. That is captured in this spread here on the lower panel. That's been continuing to decline, basically hitting cycle lows as we go here. Still at positive 21 basis points, but certainly on a pretty firm flattening trend. And that is perhaps best represented in the next chart here. I've drawn in, this flattening trend goes back to 2010, so this has been in place for a long, long time. You can see that the inversion took place here before the recession that started in 2007 and went through 2009. I've drawn in some trend channel lines here. This 2's 10s curve has really been pretty much, especially recently, kind of right in the middle of that channel, although flattening pretty quickly, so it could flatten before the end of the year or by the middle of next year. That certainly seems to be the trend that it's in. The midpoint is right around January of next year. We could see the 2's 10s inversion in the coming months. Then this chart's called yield curve segments. So the 2's 10s, or the 10-year minus the 2-year, is the one that gets the most attention by analysts in the media, and I agree it's a very important yield curve to look at. It's also worth referencing, I think, the longer segment and the shorter segment. So here I have the 30-year minus the 10-year on the top panel, and the 2-year minus the 3-month on the bottom panel. And you can see all these different segments were inverted prior to the last recession at different points in time. Then moving on to the nominal U.S. GDP growth rate and the 10-year yield. So U.S. nominal GDP growth is in gray. That's hitting a new cycle high at about 5.4%. It's a new high going back to the beginning of this expansion in 2009. And then the U.S. 10-year yield is right around 285 right now. Historically, you can see that the nominal GDP growth rate has been a reasonable proxy for fair value on the U.S. 10-year yield, with these extended periods of being above it or below it, understandably. But it's a reference point in terms of thinking about where the fair value might be on the 10-year yield. Then importantly, I think we have to cross-reference here the German 10-year yield. The German Bunds, as they're called, are somewhat of they're an alternative fixed income instrument that it can be invested in if you're a global fixed income investor. So you can see here the U.S. yield is at 285. The German yield is at 0.38%. That spread between those two is actually the highest it's been going back to German reunification in the early 90s. And so the fact that the German yields have remained relatively low could be keeping down to some extent the U.S. yields, given that global investors might, in a search for yield, be allocating money into treasuries and sort of bringing that U.S. yield lower than it might otherwise be. Part of the reason that that German yields, or that yields around the world, are low is all of this negative yielding debt. The dollar value of negative yielding debt divided by the dollar value of total debt in the world is shown here at 15%. That is, that is largely denominated in euros and Japanese yen. The European Central Bank and the Bank of Japan, the respective central banks, still have negative interest rate policy on the short end, and that is, I think, keeping much of this, or keeping a significant portion of global debt negative yielding. Moving on here to the U.S. 10-year yield, this is a long-term chart going back to the late 1980s, shows this downtrend. This is the regression line here going back to March of 87, and then plus and minus 1 and 2 standard deviations. So you can see the 10-year yield has broken out of that plus 2 standard deviation band. That's nothing too scientific, but that's just a reference point. Then my interpretation here is that the key horizontal level is probably the 310 level. That's the recent high in 10-year yields. And then similar chart here for the U.S. 30-year yield, which has actually not broken out of its plus 2 standard deviation band. It did bump up against it here. I think that was the horizontal level of 325, and I believe that's the key horizontal level to watch on the 30-year. Then moving to a really long-term picture here that includes demographics, I'm showing the U.S. median age by decade in black here. That's inverted on the vertical axis, and then the basically the average interest rate on the 10-year yield in gray by 5-year increments. And what you can see here is that there's been this general trend of aging in the U.S., which is shown here by this downward sloping black line, which is the median age inverted, with the exception of 2 decades here, and that was due to the baby boomer birth years in the 1950s and 1960s. And in my view, it may be relevant in the sense that this significant increase in interest rates around that period of time, and in particular in the 1960s and 70s, may have been related to the changing demographics, or the demographics that were particular to that period. What's noteworthy is that, one of the reasons that I like demographic analysis is that we can know with a relatively high degree of certainty what the overall trend is going to be going, a decade or two into the future, and we don't see anything that would match the demographic change that took place in those decades. So it could mean that demographically speaking, the overall trend could be lower for interest rates. Then looking at the U.S. corporate high yield credit spread, that's been contained over the last year and a half. So nothing too concerning there. I think eventually we will see this spread break higher, and that could mean safe haven demand for U.S. Treasuries. So that would mean U.S. Treasury bonds probably rally in that scenario. In other words, U.S. Treasury yields would decline. And then U.S. corporate investment grade credit spreads. So here we have it by sector. So you can see the sectors here, each color for the given sector. And then the black line is the average, and that's been also pretty well contained over the past year and a half or so. All right, then I've got my concluding remarks here. I think that the Fed's likely to continually gradually hiking rates, given that financial conditions have not started to tighten too much, and given that the Fed views the neutral policy rate as being around 3%. That's roughly consistent with Chair Powell's most recent comments at Jackson Hole. The market's pricing currently a 95% chance for a September Fed rate hike, so that would be the 3rd hike for this year, and then the market is kind of 50-50 on a 4th rate hike, which might come in December at the December Fed meeting. So I think that'll depend on how the data comes in, and possibly whether we get more certainty on the outlook with respect to trade. That's been one of the major uncertainties lingering in the question of economic growth. Then the 2s10s yield curve looks likely to invert later this year or early next year. That will be, I think, a significant event in terms of thinking about where we are now as an analog. The analog year from the last cycle to where we are now, I'd say would be right around 2005. That's kind of where we were in the flattening trend of the yield curve in the last cycle. That's often a recession risk warning, and typically is followed by a recession beginning 10 to 20 months later. There are historical examples of yield curve inversion that were false signals, where there was no recession within the following 20 months. Of course, even though we haven't had one as far as the data goes back, it's certainly possible that you could have a recession start without prior yield curve inversion. So anything is possible, but trying to go by the historical norms that we've seen. Then the U.S. 10-year yield currently looks relatively fairly valued given that it's sort of right in between where the U.S. nominal GDP growth rate is and where the German bunds are yielding. This chart book, I think, is worth cross-referencing with the Fed and U.S. Inflation chart books, which are on the merkinvestments.com/research webpage.